Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
What's going out there? It's October 23rd. I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. Hey guys, I want to start off by saying thank you for all the emails you sent regarding the health of my mom. It's hard to get back to all of you, which is really cool, so I'm trying to, but I really appreciate you reaching out. She's doing better, but unfortunately, she may need another surgery as they found a small rip in her colon. And it's very frustrating, actually, since she's been in ICU for over 2 weeks. And the hospital's in Jacksonville, so it's about 45 minutes away from my house. I've been going there every day. But now they said she could be in the hospital for another month, right? Which is kind of insane. So yeah, I mentioned last week, my mom's 76 years old, has COPD, diabetes, but she's in really good shape, very energetic, and had to get surgery on 2 hernias. And a doctor who specialized in minimally invasive surgery decided to open her up. After they opened her up, found a couple different things that he wanted to fix, and opened her up for 7 hours. So to put that in perspective, open heart surgery probably takes around 3.5 to 4 hours. So they opened my mom, 76-year-old, for 7 hours. And he said that he didn't like the way one of the surgeries looked because it was 2 surgeries, and he actually made it 3 because they went to her colon, because he said he didn't like the way that looked. But he said, hey, once I sewed it up, I didn't like the way it looked, so he did it over again. And also said, well, he was there, he operated on a colon, which required him to remove a small piece and then sew the 2 ends together. So now that he did the surgery, he obviously botched it, and there's still a tear in the colon, which is leaking blood. Now, they plugged it in hopes that it was going to heal itself, because my mom now, her vitals are fine. She's awake and talking, starting to eat solid food for the first time a few days ago. So, which is really good news, right? So she was able to get out of bed a little bit with some help and sit in a chair. Yeah, I mean, it was pretty bad there, to be honest with you. Her body went to shock after surgery. Her kidney stopped working, so she had to be on a dialysis machine. But she's doing much, much better, so I appreciate those emails. But that's also the reason why they want to try to avoid this surgery. So they want to monitor for a few weeks with the hopes that this is going to heal itself. But if not, then she's probably going to be there for another 3 weeks and then have another surgery and probably be in the hospital for another 3 weeks after that, which doesn't include the rehab, since she needs to go to a special facility and stay there overnight in rehab, so someone's watching her. So, she's not going to be home for a pretty long time. So, this whole situation has been frustrating. And, look, I just think another surgeon would have probably did a much better job. I hate to play Monday morning quarterback. So many people do. But it's been a disaster thus far, to the point where her body failed, her kidneys failed, and we almost lost her. And they actually said, you know what, you guys should prepare, get your things in order. This is after day 2, day 3. And I had to tell you something, guys. Now that I got a close look, because I've spent a ton of time in the ICU every single day. So this is day 17 now. So I've been there every day at night, pretty much from 7 to 12, 1 in the morning. It's a complete shit show. I mean, the doctors, first of all, there's 3 of them on this case, and every one has contradicted each other. And one says that she had an infection. We were like, wait a minute, she has an infection after surgery? The other said we couldn't find anything, but something's still wrong because she was bloated and one of her drains was leaking blood. And the other actually said, you know what, it might be due to a tear. Now, she's been sitting there for nearly 2 weeks when we got this news. And in the meantime, 3 CAT scans they performed on, and they couldn't find this until the 3rd one, until like day 12 or 13. And I'm like, something's wrong. Wouldn't you be focusing on it every single day? But we're getting just, so many different viewpoints. There's no transparency. And then the nurses, most of them are really nice, but there's literally a different nurse, and it's 4 nurses, right? There's 2 on like a 12-hour shift, and then the other 2 would take over the other 12-hour shift. So 4 every day, but they're new every single day. And my mom has a lot going on. She's diabetes, she got insulin shots. She was on dialysis for a few days after her kidneys, then on a temporary dialysis machine where she got better. She takes different medications for all this stuff. They started giving her food through her IV. And after not getting any food for the first 6 days, that was a big deal. Then on day 8, they just magically took it away. So the doctor came in and said, well, where's the food? And we're like, well, the nurse said she's not going to give it to her. And he's like, what are you talking about? She's supposed to get food. And they gave her a sleep aid most nights, and some nurses refused to give it to her and said, no, we can't give it to her because we're pumping things out of her stomach and things like that. And yeah, then the physical therapist started getting up out of bed after day 9 and day 10. And then the next few days decided not to come, right? Which really pissed me off because, look, that's a big deal. Because no matter what surgery you get, the 3 most important things the body needs is what? Food, sleep, exercise, right? She was getting no food for 6 days, no exercise. They didn't get her out of bed. And they were literally waking her up every single hour for the first week to take her blood, to put new lines in that's closer to her heart. So they juncture her blood pressure work more quickly. They're pricking her every hour for diabetes, giving her blood. She needed blood. Injected her with antibiotics because they weren't sure if it was an infection. They taken a temperature every couple of hours, monitor her white blood cell count, which is going to determine if she had an infection in her stomach. But all this, I mean, constantly waking her up. She didn't sleep at all. And being subject to that and being in that, I mean, it's a complete shit show. And I'm not saying it's like that everywhere. I'm just saying where she is now, which is, a big hospital. I won't name it. It's very, very big in Jacksonville. But we got the bill a few days ago. She's covered for all of it. But as of day 11, okay, we're on day 17 right now, it's $300,000 so far. Now, she's going to be in the hospital for at least another 3 weeks because the doctors botched the surgery, and she may need another surgery now again because the doctor messed up. She messed up twice. They messed up the first time and said, I messed it up. I sewed up wrong, and then it went back in there, right? Which is why they keep up for 7 hours. And then, obviously, something happened where you didn't sew up the cone right. So you're going to charge us for that? Probably. Of course they are. Of course they're going to charge for that, right? But I look at the healthcare, everything is gone. I mean, it's just crazy. And for me, when I look at they should keep the same nurses on the same patients, especially in ICU, for a few days. I mean, I get it. You want to give them exposure to numerous patients, numerous cases. They're going to get that experience. They can still get it, but maybe have them work 3 days with, say, the same 5 patients in ICU. Because in the case of my mom, where so much is going on, each nurse is basically starting from scratch. So I have no idea of her progress over the past few days other than looking at the computer, the chart statistics, but that doesn't include important information. Like how much energy she has now compared to a few days ago. What makes her comfortable in terms of pain medications? Or, they put certain pillows underneath her. She's laying down all day, what makes her comfortable, what doesn't. And the physical therapist got her up the previous day. Some of the nurses didn't know that. Or how is she post-surgery? How much has she progressed over the past few days? This is important. This is really important information. Knowing your patient. I mean, my mom hates pain meds. She avoids them at all costs and refuses pain meds pretty much 70% of the time she's been there. But she has the right to ask for them, and they can give them to her like crazy because she's in ICU. And one day she was in a lot of pain and requested pain meds, and I didn't give it to her right away. And I'm like, know your patient. I mean, this is someone who's not in there, and a lot of patients are in there and say, they're in so much pain. I need it all day. They could give it every half an hour, every hour, depending on the patient, depending on the pain. She never asks for it. So if someone like that asks for it, take it more serious. She's in pain. She's like, pain's a 10. I really need it. And they were like, okay. And an hour went by and she's excruciating pain, which she doesn't need to be in if they gave her medicine. But man, it's just a real shit show, especially given that they didn't even tell us what was wrong with my mom post-surgery for 12 days. Now they finally found that tear, right? She's been there for 2 weeks in ICU, and now they finally tell, after the 3rd CAT scan, there's a tear there. Yep. Anyway, I didn't mean to go that much into it. I just want to update you since so many email me, and I really appreciate it. And again, guys, I'm not telling you this story for you to feel sorry for me. You all have problems that, be really tough times. But I'm sharing this story hoping that, not hoping, hopefully none of you go through this experience, but if you do, you can be prepared a little bit because I wasn't prepared at all for this. I didn't see this coming. I thought this was a typical surgery, pretty straightforward. He had 2 hernias. He said he might go in there, might find a couple of things. He wound up doing an additional surgery, open up for 7 hours. All this nonsense is going on. But, hopefully from listening to this experience, you could be prepared, maybe know what questions to ask the doctors or the nurses before and after surgery. And again, hopefully avoid a situation like this. Because again, when you see it up front and you're there every day and everything that's going on, I'm not saying every single hospital is like this, but these are facts I'm giving you. This is really what happened. Imagine you have a loved one and they botch a surgery, then for 2 weeks they're in ICU and they can't tell you what's wrong with her. If you don't know what's wrong with her, you should be doing tests every single day, not every third or fourth day. But very, very frustrating experience. But she is doing better. Her vitals are good. She's all there. It's great. Hopefully she doesn't need another surgery. If not, then she'll probably be home within a month. But we'll see. I mean, I'm just, fingers are crossed because after this experience, I'm a little nervous if she's going to have to go under again. And it might not be good. So again, appreciate all your thoughts on that. So let's move on. Have an awesome guest this week. It's the first time it's been on the podcast. The person I shared the stage with several times at conferences. I love his opinion on so many macro issues where macro could be boring sometimes, but this guy's entertaining, super smart. Also has a pretty big following on Twitter because he's very funny and witty. So I know you're going to love this guest and love this interview. His name is Brent Johnson. So Brent has had 20 years experience in the financial industry, CEO of Santiago Capital, where he manages money for high net worth individuals and families. He also has his own gold fund through Santiago Capital, but he's been managing money for a long time. Places like DLJ, which was a big name back in the day. For if you're a millennial, you probably never heard of them. Spent 9 years at Credit Suisse, where he's vice president of their private client group. Just fantastic stuff coming. In this interview, he's going to be talking about gold, where he thinks it's heading. He's not a gold bug. So this is going to be a good conversation, and it's going to be even better when you hear his prediction for the dollar, which makes no sense at first, but he's going to explain why, because his prediction on a dollar kind of contradicts his prediction on gold. So it's going to be really interesting. He's also going to break down the Fed and tell you how long the latest round of QE will last. But wait, we're not allowed to call it QE. It's not QE. It's never QE. You can't call it QE. But we're going to break down the Fed and see what's going on there and how long they think and how low interest rates can actually come. And of course, like always, with all my guests, going to share some of his favorite ideas with you. So really great interview coming up, guys. I know you're going to be excited. First time guest, and Brent's awesome. Then in my educational segment, I'm going to break down some of my favorite investment strategies. One that I covered several times with you over the years, and it has to do with one of my favorite sectors, which is biotech. And why am I bringing this up? Because if you use this strategy, you would have bought Biogen when it crashed in March after reporting weak test results for its signature Alzheimer's drug. If you haven't been paying attention, it's been the biggest story this week. On Tuesday, Biogen saw 30% and the company reported positive results on this same drug, which means there's a good chance it's going to get FDA approval by early next year. And this is a big deal because there's zero treatments for Alzheimer's. This is a multi-billion-dollar industry basically wide open. So it's a huge breakthrough where I think the stock is still cheap after this move, maybe worth buying, but I'm going to break down my strategy, how it worked to a T with Biogen, whose stock soared tremendously on Tuesday. And also, I'm going to share another biotech name with you that actually has a much better drug in its pipeline than Biogen's to treat Alzheimer's, to 2 phase 3 studies. It has enormous potential. The stock actually went up 8% on the Biogen news because it's targeting the same factors that Biogen is targeting with this drug, except as better safety, better ways of taking this medication. So I'm going to break down this whole segment, break down the strategy of my educational segment. Definitely one you don't want to miss. Before we get to that, let's bring in Brent Johnson, first-time guest, brilliant analyst. And here's that interview right now. Brent Johnson, thanks so much for joining us on the podcast.
Happy to be here. Been looking forward to it.
Well, I'm going to jump right in here. And I wanted to get your outlook for gold because you're bullish on gold, but you're also super bullish on the dollar. And usually gold and the dollar move in different directions, at least pretty much since the credit crisis. But you're bullish on both, which definitely separates you from a lot of the gold bulls out there. Explain that thesis.
Yeah, so thanks, because this is I think this is something that's crucial to understand, and I'm gonna take a minute to kind of set my answer up, because back in 2016 I put out a presentation which I called "Step Into Liquid," and it was it kind of went around the world and explained that's where I kind of started to lay out my bullish dollar thesis and why I thought certain things would happen which would make the dollar rise. And I think that was surprising to a lot of people because I have been such a big proponent of gold for the last, call it 8 to 10 years. And, you know, the typical argument for gold is that the dollar is going to get inflated away and therefore you want to own the one real asset that can't happen to, right? But I just see a number of fundamental reasons that the dollar is going to get a lot stronger. But what I think a lot of people forget is that the monetary system is designed such that the dollar get weaker. And so as the dollar gets stronger, it will literally cause chaos, a global currency chaos event, and it will wreck the monetary system, the design of the monetary system. And I see nothing more bullish for gold than the destruction of the current monetary system. And so, like I said, I started this 2 or 3 years ago, and now, and I said at some point we'll get into a period where the dollar and gold will rise together. Now, I also made the argument that the dollar would break out prior to gold. Now we've seen this year gold appears to have broken out prior to the dollar. So, I can't claim to get every part of this right, but and even in the last couple of weeks, you saw. Gold has pulled back over the last month, and the dollar's pulled back over the last month. So, it's interesting to see this positive correlation between dollar and gold, and I think it's because they are both, for lack of a better word, a safe haven trade. Now, I know a lot of people who think that the dollar is an absolutely horrible currency, and I agree with them, except for every other fiat currency. I mean, fiat currency itself is doomed to fail. I mean, anybody who's done even a cursory glance at history knows that fiat currencies fail. So I don't personally find a lot of value in saying fiat currencies go to zero. Where I do find a lot of value is if you can figure out which currencies will perform better versus another fiat currency. So getting back to whether I am bullish dollar or bullish gold right here, I am of the belief that short term, let's call it over the next 6 to 12 months, that gold is going to pull back and it will at least retest the breakout zone of 1375 to 1400. Now, I should make it clear, I own gold. I think everybody should own gold. If you're sitting there without gold, I don't think you should just sit around and wait for that to happen. I view it as insurance. I think it's a necessary part of a portfolio. But if you're asking me what I think is going to happen, I think in the near term, gold will pull back and it will at least retest that breakout zone. And part of the reason is I think the positioning has gotten kind of offsides in the COT. And I think the dollar is going to make a move sometime. And when that happens, I think that will be a headwind for gold. So, but eventually we'll get into a period where I think they will both rise together dramatically. And eventually I think gold will be the best beneficiary and the dollar will eventually get revalued lower and gold will be the last man standing. So I hope that wasn't too much of a rambling answer, but that's kind of my theory.
That was great. And the reason why I love having you on this podcast, because as well as I do, some people are over the edge when it comes to gold, right? They're going to say, you got to buy it no matter what every single day. It should be the biggest part. There's just gold bugs out there that are nuts. I just like to talk to people who are reasonable because times change. And sometimes it's a great time to buy certain investments and sometimes it's not, which brings me to my question, because you have a pretty cool Twitter following. I follow you. I love you. It's entertaining. And if you say one negative comment on gold or even talk about the dollar going higher, there's people that actually come after you. Now, why do the diehards who own gold? I'm trying to why are they so emotionally attached? Because from my experience of researching stocks, and Brent, I've been doing this 25 years, when people get emotional about their investments, what we're seeing, the Tesla bears, the gold permabulls, and the Fed haters, it usually means that they're wrong.
Yeah, and listen, I have a lot of friends in the gold world, and I think that they are amongst the most well-intentioned, hardest-working, honest people I've ever met in my life. Now, that doesn't mean they're all that way, but I'm just saying that a lot of the people that I know in the industry are in there because they see the problems with the central banks and the fiat currencies, and they know it's going to end badly, and I think they actually are really trying to help people. But I do think that they suffer from some of the same biases that they accuse traditional Wall Street of suffering from. My point with gold is, yes, listen, gold is going to go to $5,000. I don't think it's going to happen in the next month or 2 months, but I could be wrong. So I own it. But it's not enough to say that gold's going to go to $5,000. I need to say it's going to go to $50,000. I need to say it's going to happen tomorrow. And I need it to say that the Fed is going to end up in a heap of burning ashes. So I do get frustrated with that part of it because I think gold is doing exactly what it's supposed to do. I think it will do exactly what it's supposed to do when the time comes. And I think that's enough. I don't think you need to say that it's the only asset everybody should own. And the point that I try to make with people is this: okay, yes, let's own gold. And let's say that you have 20% of your portfolio allocated to gold. Now, that's, for most people, that is a huge amount. Now, for a lot of gold bugs, that's not enough. But that's one of my other things. It's never enough, right? If I said I owned 50%, well, what do you do with the other 50%, But let's just say you had 20% of your portfolio in gold. My point is, even if gold goes up versus the dollar, I believe the dollar is going to go up versus all the other fiat currencies. And the way that markets are priced right now, they are not expecting that to be the case. So the opportunity to profit if the dollar does go up versus all these other currencies in the way that I think it's going to, the asymmetry of some of the trades that we can put on almost demand that you do the trade. In other words, if I'm wrong, I'll lose a little bit of money. That's fine. But if I'm right, I'll make a killing. And those are the types of trades that I'm happy to take. So, I think everybody should own gold, but I think that once you buy your gold, there's not much else to do. Right? You've got your gold. Now look around for some opportunities with the rest of your portfolio.
Well, let's talk about those opportunities because you mentioned the Fed earlier, and we know the Fed's easing. A lot of people think, well, it depends on where inflation is. If you really look at where interest rates are trading in corporate bonds, or if you look where interest rates, the negative yields are around the world in corporate bonds, and even where treasuries are, they have to ease right now to be more competitive. So I think it's priced in that it's going to go down probably 1%. I guess two questions here. One, is that like automatically, because what we saw what happened last time they eased, where all assets increased tremendously in value, is that basically the green light to say, hey, you have to own equities or you have to own assets? And also, and this is the second part of the question, is why do we need to have such a big debate on whether this is QE or not, or if it's how it's defined? I mean, it is QE, but it's like if you say it's not QE, the Fed comes out, but it is QE. What's the difference, right? Every central government's easing around the world, but I guess, what's your thought on the Fed and even the dollar going higher? What are some of the investments outside of gold that you're looking at?
Yeah, okay. So again, I'm going to take a step back and I'm going to set up my overall premise a little bit because it'll help me address this question in better detail. Now, I don't have time to go into my full presentation, but long story short, I have made the argument that part of the reason that the dollar would get stronger was that our rates relative to the rest of the world are higher. And I thought, and I still believe that as we move forward in time and as the global economy slows, which I think it is, globally, not just in the U.S., not just in China, not just in Japan, but everywhere, I think the global economy is slowing. I said that our relative strength of our rates and the fact that the world still operates on dollars, like it or not, the world does still operate on dollars, that would push global capital flows to the United States, and that would provide us the ability to weather the storm better than the rest of the world. And as part of that thesis, I was not convinced that we would have to, cut rates as aggressively as we have and go back to QE. Now, we have had to cut rates, and we have actually, I believe what they're doing now is a form of QE. Now, I am not going to sit here and say it's not QE, it's QE, but I am also aware of the fact that it is not the same as prior QEs, and it's not. And I think if you say it's not QE, you're not being intellectually honest. And if you also argue it's the same as prior, then you're not being intellectually honest. They are increasing the balance sheet. It is QE, but they're targeting the front end now, and it's really a short-term liquidity thing. Whereas QE was targeting more of the long end of the curve and was actually changing the balance sheet of the companies that they were doing QE with. So again, let me give you an example. Right now, if they do QE with JP Morgan or HSBC or Deutsche Bank or Credit Suisse or Bank of America, whoever it is, they're just doing a very short-term 2 to 3 day, 5 day, liquidity transaction in the repo market. In QE, they were going out and buying long-term bonds that were sitting on those companies' balance sheets, removing those bad bonds or those bonds from the balance sheets, and they were improving the overall capital structure of those balance sheets of those individual companies. They're not doing that now. Yes, they are definitely providing them short-term liquidity, but it's not a effort to increase in order to pull the long end of the curve down, and it's not an effort to improve the balance sheet of the company. So it is a little different. But I still think even if they have to continue doing this on a relative basis, our markets and our treasuries pay a hell of a lot more than anywhere else in the world. And on a relative basis, I still think that is a destination for global capital flows. And I think as we get into this decelerating environment, I think we will get more of those capital flows. And I think that will keep us, we may have to do QE and we may have to continue to do these types of programs, but I don't think we will have to do it to the same extent as the rest of the world. That's another thing that I'll make a real quick point here is that everybody's, piling on that the Fed has gone back to doing QE, but these these QE repo transactions that they've started doing in the last month, China's been doing them all year. They've been doing them for 2 years. Europe's been doing them forever. Japan hasn't raised interest rates in 25 years. So again, yes, we are having to do these things to combat the slowdown, but on a relative basis, we're not doing it as much as everybody else, and we're not doing it to the same extent. And we have 9 rate hikes behind us from which we can do these without getting down to 0 rates. So I just feel like on a relative basis, the U.S. is going to be a relative safe haven as we move forward into this, what I think is going to be a currency crisis.
So a lot of interesting things you said there. One of the things is, you point out the slower growth. Europe, you look at Asia, most developed emerging markets see slower growth. When I look at U.S. stocks, they're trading close to all-time highs. And yes, this is the safe haven. So, can this rally, or I should say rally, because it's basically a bull market outside of last year where we had a 20% correction for the first time since credit crisis, but we bounce right back, and every time it comes down, it's a buying opportunity. But could the U.S. stocks continue on this pace? And yes, we all know that Trump is pro-market. His gauge that he looks at is the S&P 500. We know that the Fed's easing. But I would think it's going to get more and more difficult because we're not getting any help from developed and emerging markets right now. And it looks like that trend is slowing down along with ours. We're slowing a little bit more. So I guess my question is, with the U.S. being the safe haven, is it going to be treasuries? Is it going to be dividend-paying stocks? Or is it kind of be, hey, everyone's just going all in on the market? That's why it's hitting all-time highs.
So I believe that treasuries will still be well bid. That's another thing. You look at I think it was a 5-year auction that they did today, and like 60 to 65, maybe 70% of it was taken down by foreign investors, right? So the idea that the rest of the world is no longer going to fund our budget, I think, is just wrong. Now, I hear that a lot, and I hear everybody saying we're going to de-dollarize. They hate the treasury. The only reason that the Fed is doing this repo is because they're monetizing the debt. I understand those arguments. I just don't buy it. Now, we may eventually get there, but I think the rest of the world is still more than happy to buy our debt versus European debt or versus Japanese debt or versus Chinese debt. Now, it doesn't mean that our debt is great. I just mean it's better than everybody else's. So I think that they will continue to do that. But I also think that as we move forward in time, that yields around the world, while they may fall lower in the short term, I think sometime in the next couple of years, yields outside the United States are going to start rising on credit party concerns or counterparty concerns. So when people realize that when people realize that Greece is never actually going to pay them back for this negative debt that they just issued, I think the yields will rise as a result. I think the yields for Italy will rise as a result. I think the yields for China will rise. I think the yields for Australia and Canada will rise, not because things are getting better and there's inflation expectations, but because things are getting worse from a credit perspective. And when that happens, I think that will also contribute to money coming to the United States. And I think it will start to go into not just our treasuries, but into our equities. And so I think, to your point, I think large blue chip dividend paying stocks will look very attractive. And I've used this example before. Is imagine that you're a pension fund manager in Europe and you're looking around of a place to allocate capital, and you can buy an Italian bank or you can buy a JP Morgan, right? Or you can buy an Italian corporate or a Portuguese corporate, or you can buy, Philip Morris that is based in the U.S. and has a 4 or 5% dividend. And has had a big pullback here, right? I think and then if they do that, let's say they allocate, they get the 4% dividend, the dollar appreciates 4 or 5% versus the euro, and maybe you get a little capital appreciation. All of a sudden, you've got a 12% return rather than holding a Portuguese corporate. So I think that type of stuff will continue to happen. Again, what I think a lot of people, when they look at the market, they think, you know what, this is crazy. The valuations are bad. I'm just going to go sit on the sidelines. As individuals, as retail, you can do that. But the big institutions, the big capital allocators cannot put 50 or 60% of their money in cash. And even if they could, they wouldn't do it because they're so afraid of losing their job if their peers outperform them, right? So the money is going to go somewhere. And I think as they look around, the U.S. is going to become increasingly attractive. And we just saw last month, or I think it was in August, the Pension Fund of Norway, the largest sovereign wealth fund in the world, made a recommendation to the Norwegian government that they decrease exposure to Europe and allocate that decreased exposure to the United States, including United States equities. So I think that's a trend that's going to pick up. So as a result, I think that the Dow and the S&P, I think we're going to have a spectacular blow off top over the next couple of years. Now, I know a lot of people think that it's already happened, that the last couple of years have been the spectacular blow off top and that it's going to roll over, but I happen to believe that it's still to come. Now, I should say, and I know I'm rambling again, but I just think this is all very important. A friend of mine, and I'm not going to claim credit for this work because I didn't do it, but a friend of mine, very, very smart guy, very well known in the industry. He, I'm not going to say his name, but he's done a lot of work on this. And he has done a lot of work on the relationship between passive investing, which is basically the world's simplest algorithm, which says if there's cash in the account, you buy. It has nothing to do with valuation. It has nothing to do with earnings potential. It has nothing to do whether a company has a good balance sheet or not. Literally, if the cash is in the account, they just go buy, right? So so as cash comes in, that can also lead to flows or to equity prices rising. Now, the second part of work that he has done on the same thing is also as part of the rise of passive investments. This is indexing, this is ETFs, this is, basically, not a manager making a decision, but just buying the S&P 500 or the Dow or whatever it is a lot of IRAs and 401ks have invested in these types of assets. Well, it also happens that there's a demographic cliff in the United States where a lot of the baby boomers who are accounting for the biggest portion of wealth in the country are retiring. And not only are they retiring, but they're hitting age 70. And in the United States, when you hit age 70 and you have a big 401k or IRA, you are mandated to take 4 or 5% out every year. It's called a required minimum distribution. Well, last year in the fourth quarter, what happened was you had this big cliff where all of these, this biggest section of the market turned 70 and they had to take 4 or 5% of their money out of their 401ks and IRAs. And guess what quarter they did that in? They did that in Q4, right? And so when the market was already trending down a little bit, it was like a couple $100 billion had to be sold in order to meet these required minimum distributions. The interesting thing is that happens again this year. And not only that, but it looks like it's an even bigger number this year than there was last year. Again, this is just demographics, and it goes into the fact that these passive investments, the same way when it says if there is cash buy, it's also if there's a redemption request, just sell. It doesn't matter if, what the position's doing. It doesn't matter if you love the positions. It's just sell. And so what we believe happened last fall was that you had this this wave of selling that had to take place, combined with the simple algorithm that if you get a redemption request, you sell, and it had accelerated in Q4. But once those required minimum distributions were gone, you were back to the other side of that very simple algorithm, which said if cash, then buy. And as people started contributing to their IRAs and 401ks again in January, you saw it ramp up the other way. So we think it's possible. Now, this is not a prediction, but we think it's possible that same dynamic plays out again in the fourth quarter here. So we are prepared. We have some hedges. And so I should say that we have exposure to equities. We believe equities are going much higher over the next couple of years. But in the short term, we do have some hedges going through the fourth quarter because we think it's possible that we get a similar play as last year. If that happens, we will be aggressively buying into that weakness.
Yeah, I love it. Love that thesis. So I got 5 minutes left, so I want to try to squeeze in 2 more questions. You're a macro guy, but I love it. I know my audience loves as well. My guests offer some ideas to invest in. Not sure if you have individual names you like. If not, is there a sector ETF you like? Maybe a good short over the next, say, 6-12 months. And you kind of mentioned that, over the next 3 months, it's not a prediction, but we could see the market fall. But if that happens, you're going to be aggressive buyers. But do you have anything to play that or something else that you're looking at? And if not, it's perfectly fine, but I always ask that of all of my guests.
Well, unfortunately, I don't necessarily have anything in the ETF form that's easy to play. I do in the fund that we manage, we do some more exotic and some option-based stuff. So I'll tell you one of the things that we do think is going to happen. One of our biggest positions right now is we are betting that the Bank of Canada is going to have to change their hawkish stance and reverse course and start cutting rates aggressively over the next, call it 9 to 15 months. And so our biggest play right now has been buying options on something called a Canadian banker's acceptance notes, which is really just a bet on whether or not they're going to have to cut rates. And it's great because the market is pricing in about a 5% chance that they cut once, and we think that there's a very high degree probability that they're going to have to cut multiple times. So the pricing on these things is just astronomical. We can get them for very cheap, and if we're right, we don't make a little bit, we make a ton. So that's so the way that you could potentially place something like that as an individual would be to look to ways to play, the Canadian economy turning down, whether that's buying Canadian treasuries because because they're going to cut rates. That's something you might consider. Again, if it kind of depends if you're a U.S. dollar investor or a Canadian dollar investor or where you're based, but that's something that we're really excited about and that we're looking at. And so maybe you can find some knock-on effects of that happening.
Canadian bankers acceptance notes. Just when I thought I heard all of the impossible investments. That's great stuff. I love it. So last question. This is by far the most important thing that we've talked about so far. I read someplace that you played JV basketball at the University of Kansas, which is my favorite, not just favorite team, but probably my favorite team in all of sports.
Oh, man. Rock Chalk Jayhawk.
Diehard fan my entire life since I first started playing basketball at 9 years old, and I'm still trying to play even though it gets harder as I'm in my late 40s. So the most important question, does Kansas have a shot at making it to the Final Four this year?
Boy, that's a good question. They always got a shot. They've got so much talent there, and they always get a great recruiting class. And I think Bill Self is about as good a coach as they get. So, I never bet against Kansas. That's one thing. I will bet for other teams from time to time, but I never ever bet against Kansas. They when I was a sophomore in high school, they won a national championship. And 20 years later, in 2008, my son was not born yet, and he was still in my wife's stomach, and they won another championship. So. That was 11 years ago, so I hope I don't have to wait another 9 for him to win another one, but I'll definitely be pulling for him this year.
Yeah, and that last one was kind of crazy, too, with Chalmers.
It was fantastic. So. I got to tell you, there is nothing like playing basketball in Allen Fieldhouse.
I mean, I've been there. It's incredible. I've seen a game there. It really is. But I'm just such a diehard, and hopefully everything is cool with Bill Self and everything, the allegations and stuff like that. I know what's going on, but we'll see what happens. Again, if the guy in Arizona got off when they got him on tape,
it's all a big game, isn't it?
It is. It really is. So listen, Brent, thanks so much for coming on the podcast. You did come on in short notice. I love first-time guests. Love your opinion. Even when I shared the stage with you, I was just really impressed with. We have a lot of guys out there that just tell you, hey, buy gold no matter what. You're a gold fan. I like gold. I have 10% of my portfolio. But just like you said, and it's different from what everybody else believes in this industry, right? Because if you post on Twitter, on your Twitter account right now, that, hey, the market's going to go a lot higher in the next couple of years, you're going to get shit for it. But it's just amazing. And you know that when you get shit for it, that usually means you're often more right than wrong. So Listen, thanks so much for coming on. Hopefully I'll see you again soon. And thanks, buddy.
Absolutely. I'll come in anytime. Just let me know. Thanks a lot.
All right, guys. Great stuff from Brent. I shared the stage with him several times. One of recent times, I think, was a year ago at the Cambridge Conference, San Francisco, where I was on stage with him with Doug Casey. I think Marin Katusa was moderating, and Rick Rule and Grant Williams. I think Marin wanted to do a certain format where we were all in the back, and then one comes out and for 10 minutes at a time. I don't know what Marin was thinking at the time. But it was cool because we were all hanging out back there, and I got a good chance to talk to him, meet him, and just a great guy, as you could see. Very, very smart, very sharp. And I like his take. I like his take on the markets where, we really want to know about gold, but we don't want to know from gold bugs who are going to tell you no matter what the situation is, we're buying gold no matter what. You got to buy it no matter what, which is the worst advice possible for the last 7 years. And that's why I like it, because he'll change with the facts. He'll look at the facts. And yes, he's an investor in gold, but he's not just this huge cheerleader. And, he's involved in other situations as well. And just, for me, I have a lot of respect for him. I think he's a great guy. And, after meeting him and following him for a little bit, and I follow him on Twitter as well. He's got a pretty big following. He's always impressed me. He always has great research. And So anyway, that's my opinion of it, right? I always say this podcast is about you, not about me. Let me know what you thought at frankcurzioresearch.com. That's frank at curzioresearch.com. Now, let's have some fun and get to my educational segment. It's about Biogen, symbol BIIB, whose stock soared as high as 40% on Tuesday after its drug to treat Alzheimer's, saw very positive results. So now Biogen is filing for approval with the FDA, which would probably bring this drug to market early next year if it gets approved, if approved yet. Now in March, clinical studies from the same drug, they did not achieve what they call in the language in biotech, its primary endpoint. That means the results are bad. And the stock crashed. Biogen crashed $100. Crashed from $325 to $225. 30% decline. So guys, Biogen is a big company, close to $60 billion market cap. That was in March before this Alzheimer's drug failed to meet its objectives. So you're looking at pretty much $18 billion in market cap that was wiped out in one day after they released these results in March. Now, brought this drug back to the market and reported positive phase 3 results. And this wasn't the same study. This is one that was in a longer-term study. I'm going to break down details in a minute. Results are positive. Stock went right back up again, captured most of their losses, more than half of their losses. So a few things here. When it comes to Alzheimer's, there's 0 drugs on the market to treat this terrible disease. You're looking at all the major players, Merck, Roche, keep going. I mean, dozens of companies tried to bring drugs to market. All of them failed. And it's tough because they failed in the late stages, which means what? Which means these companies spend a shitload of money, right? If it fails early, clinical trials, phase 1, fine. You spend a little bit of money. Go 2, 3, those are bigger trials. Those are more detailed, right? It's cost a lot of money. It costs like $1 billion to bring a drug to market sometimes for some of these major players. By the time you start to, I think it's like 8 years. And that 8 years, it's under patent, even though you can't sell it and doesn't have the FDA approval. So you really have 12, sometimes 12 years, 10 years, 8 years, depending how long you brought it to market, before they can go generic and you lose those patents. Now, with Biogen, they said that with this study, patients who received the drug, I'm quoting them, experienced significant benefits on measures of cognition and function, such as memory, orientation, and language. This is an incredible achievement, of course, for Alzheimer's patients. I mean, God, I just hope none of you have been touched by that disease to the point where, a family member, it's really, it's crazy. It's just, it's not fun. It's not a good situation. And, when we're looking at the numbers in the industry, I mean, Alzheimer's is such a monster market because there's no drugs on it, and not just in the U.S., but abroad, where this disease affects tens of millions of people. And this number is going to continue to rise because we have an aging population, not just U.S., Asia. I mean, look at Japan's demographics, huge aging population. So, yeah, it's a huge win for Biogen right now, but it's not 100% approved, right? The FDA is going to take a look at it, but it looks good. But another reason why I'm talking about this in my educational segment is because I covered in detail about one of my strategies for picking biotech stocks. And it's resulted in a ton of winners in this crazy volatile sector for me and subscribers over the past 2 decades. Now, this strategy, and it's just one of a few I use for biotech, is used for, buying particular biotech names and buying the ones that report terrible results or bad results or fail to meet their primary endpoint on one of their signature drugs. Because when this happens, what do you think happens to the stock? I mean, Biogen fell tremendously, large cap, 30% in one day in March. Look at it, small caps, guys. Holy cow. They just have a few drugs in their pipeline. And you'll see some of these names fall 50, 60, 70% in one day on this news. It's crazy. Now, when you see this happen to a biotech company, and by the way, it happens often. They're always running studies, phase 1, phase 2, phase 3. If you look at a FinViz, a free site, almost every day you'll see a biotech on their front page since they list the top winners and losers every day, including small microcaps. But you'll see a biotech name on that list down more than 40% every day. You'll probably also see one that's up like 60, 70, 100, 200% every day. And it's a biotech name. But when you see one that's down because of poor results, dig into the news. Because the FDA is not satisfied with the study. It didn't pass their primary endpoint. It doesn't always mean the drug's going to get pulled from the market. I mean, a lot of the times, the FDA is just looking for better data in regards to safety, efficacy. You're looking at a slightly higher percentage when it comes to the success rate in patients. So they know exactly after talking to the FDA that, hey, this is what we want to see. And if they think they could achieve that by tweaking a few things, maybe increasing a dosage, whatever it is, they'll perform a new study. It'll probably take 6 months, 9 months to bring it back to market. And if they report positive results, you're going to see what happened. Same thing with Biogen. Right? Stock crashed. They reported good results on this drug, and now the stock came all the way back. Now, specifically the case, for Biogen, in March, it said after the test results that they're going to discontinue the drug. And this results based on a futility analysis, which is conducted by an independent data monitoring company, right? So futility analysis is simply a pre-study. It's an early look to see if a drug's likely to succeed and worth continuing, because I mentioned earlier, it costs a lot of money. And this independent body said, you know what? No. So most investors and analysts believe the drug was gone. It was off the table. You'll never see any news about this Alzheimer's drug from Biogen again. And if that's the case, ignore my thesis. Right? Because I don't want you buying a stock that just fell 40, 56% negative news because they had bad results on a signature drug. And then, that company say, hey, it discontinued all trials. All bets are off. But with Biogen, the trial they halted was one that only ran through December 2018. Now they had another trial where patients received higher doses of this drug, which, by the way, targets amyloid, which is a protein that accumulates in the brain of Alzheimer's patients. It's widely believed to be like the primary cause of disease. And they continued this long trial after consulting with the FDA because this specific trial had included a much larger data set. So more patients were tested. And this data became available after the independent monitoring committee advised Biogen to halt studies on their other tests, right? So you had to do a little research on this because it looked like it halted everything, but they didn't. That's what pissed off the analysts. The analysts are pissed off that all of a sudden this drug came back to market and it reported positive results. They thought it was completely off the table. If you did a little homework, it's different. Investors are happy. The sell side analysts, most of them are pissed off. They're like, well, you should have been more transparent about it, but you could have read up on it and did your own homework. Now, again, this drug still needs to receive FDA approval, which is no guarantee. But if the drug does get approved, the estimates that I'm seeing from analysts in the industry over the next 10 years, again, just for this one drug, it has the potential to generate more than $10 billion in sales. That's how big this market is. It's a monster market with no one in there. Now, let's get back to the purpose of this educational segment. First, if you look at the media, I'm not going to say the media got this wrong. They were right. Biogen said they're going to hold studies in March. But, again, that was a huge headline causing the stock to lose, what was it, $18 billion of its market cap one day. But a few months later, there was no coverage saying that, hey, there's another trial, a long-term trial that is still open for the drug. Now, say you decided to buy Biogen on the pullback in March. And let's say this long trial that was positive, they just announced it was positive on Tuesday. Let's say that trial fails as well. And you bought the stock. You bought the stock, whenever. After this news, it kind of stayed like at 225 until, it broke. It's like 280 now. And it went higher just, on Tuesday. But, say you decided to buy Biogen after March and that pullback, and that trial failed. The stock already got crushed. So the risk is already priced in. In other words, your risk is probably limited with a large cap leader like Biogen, since it already is down 30% with zero expectations that this Alzheimer's drug actually could make the market, right? But now let's say the reverse happens. If this drug does see positive trial results, and which it did, which is announced on Tuesday, it's a monster score with the stock surging more than 30% in one day. Now, let's look at this from a small cap point of view. Because on negative news, these names are going to fall 60% plus. Seen it happen all the time. And when they do, everybody runs to the exits. I mean, they destroy it. I mean, it should be down maybe 35, 40%. It'll go down 60, 65%. Nobody cares, especially with algorithms today too. Just pouring it on. And sometimes they'll fall below the level of net cash they have in their balance sheet. And a lot of these companies have other drugs in their pipeline. So if you decide to buy it when it's down below its net cash value, and again, you got to look at their cash burn rate and things like that. See, they can have $200 billion in cash, the market cap can be 150, but if they're burning $300 billion a year, that's a problem. Anyway, but you're buying the stock, you're basically getting their pipeline for free, and the stock's trading below cash. Now, the game here is when it comes to biotechs, you want to buy stocks that have tremendous upside if their signature drug gets approved, right? You want that. That's what we all love. It's a game changer. But you also want to limit your risk, right? In case a drug fails to meet its primary objectives, which happens more often than not, as most drugs do not get approved by the FDA. Because when I look at some strategies out there, and I know some analysts in the industry and newsletter writers, they like to buy biotech stocks after they get phase 2 approval on a drug, and phase 2 is the most difficult to pass. 1's kind of easy, 2 is really difficult. Most don't make it past 2. When they do, of course, the percentages increase that they'll go to phase 3. So when they do get phase 2 approval, what do you think happens? The stock runs up tremendously. If they get phase 3 approval and eventually bring the drug to the market, the stock will definitely run higher. But if they fail and they do not pass phase 3 trials, the stock gets murdered. These are the ones that you see go down 60, 70, 80% because there's such high expectations in them. And that's something what we saw with Biogen. As a large cap, it went down 30% one day because there was high expectations for this drug. So when it comes to biotechs and investing in general, it's okay to take on risks. In fact, I'd argue every investor should have some speculative positions in their portfolio, no matter what your age. Obviously, if you're older, a very small percentage. But the biggest mistake I see investors make when they buy a speculative investment, the reward is not great enough for the risk that they're taking. In other words, say if you have $5,000 and that's play money to you, just say maybe it's 500, maybe it's 100. You want to make sure if your downside risk, your potential loss is the full amount of money, that your upside should be at least 3x or greater, right? I mean, investing $5K in a drug after it receives phase 2 approval, which some people do, the upside is likely to be more than 1x, maybe 1.5x. Again, since the upside's already priced in, I'm hoping not to lose you here. Trying to make this simple as possible. Because when it comes to biotech, I like buying names after they get dinged on bad trial results. They get nailed. Why? Because buying them is going to lower your risk considerably. A lot of these things will trade down close to cash. Of course, you have to look at the report and see why the drug failed. Because if the company says this is a disaster and we discontinue the studies, then move on. But a lot of times, they just need to improve safety. Get the percentage of patients that had success taking the drug a little bit higher. To tweak a few things, maybe give them a higher dose, whatever, to get the results a little bit better for the FDA. If the new trial is positive, the stock is going to rip higher, capture all those gains it lost, and it's going to happen quickly, sometimes 36% in a day. I mean, I've seen some small caps in the biotech sector surge 200% on positive phase 2 trials. So it's just about risk reward. And guys, this is a strategy that worked for me numerous times over my career. And it's a strategy I learned from some of the best biotech investors out there. And I'm not telling you this in an arrogant way where, hey, my methodology, picking biotech stocks is the best in the world. It may be pretty close. And the reason why it's good is because I made a lot of the mistakes that you made. You're investing in this sector early on in my career. I mean, I learned from these mistakes and buying on positive. The last thing you want to do is buy biotech on positive news. It's a disaster. It's a disaster. It's just after that news and that study, the company's probably not going to report any news for another 3, 4, 5 months. And it just sits there and drifts lower. And some people buy them after they receive FDA approval. And that's the worst time to buy them. Because now, instead of being scientists and all the, and studies, you're a real company. Well, I need facilities, distribution facilities. You need sales teams. You need people to represent you for healthcare. You got to try to get insurance. I mean, it's a total, you have to hire a whole new set of people. And the estimates these analysts put saying, oh, FDA approval, it's going to generate $10 million in the first year, $300 million in the second year, and $1 billion in the third year. And they won't generate any sales until like year 2 because it's hard to get everything ramped up and these stocks get crushed a lot. So when I look at this strategy, it's worked for me. It worked with Biogen. That's on my track record, which of course is not 100%. I stopped out numerous biotechs for losses over the years, but it's allowed me to really nail some monster winners, including a 500% gain, some of them more than 1,000% gains using this strategy, which is what? Essentially a way to invest in this volatile sector and take on less risk, but you're maintaining that massive upside potential that will attract us here, right? That's why we love investing in the biotech sector. Now, before I go, I'm going to tease something. I'm going to mention on my Frankly Speaking podcast. You guys know by now this podcast only goes out to my paid subscribers. That includes subscription to any of our paid newsletters. Dollar Stock Club is $39 a year. Curzio Research Advisory, we usually sell it for under $100 a year. And anyone subscribed to higher end services, they get my Frankly Speaking podcast where you get to ask me questions and I answer them. And on Fridays, Frankly Speaking, I'm going to do something different. I'm going to give away a pick because there's another company with an Alzheimer's drug, and that drug's in 2 phase 3 trials. That's also targeting amyloid, which I mentioned earlier is the protein that accumulates in the brain of Alzheimer's patients. But this company's drug, based on early tests, has a much better safety profile. It's also administered in a much easier and better way for patients than Biogen's drug. Again, I don't want to give too much away, but this company, if I had to guess, 99% of you never heard of. It's definitely off the map, never mentioned in the media, no way. And it's not a small cap. It actually has close to a $5 billion valuation, great pipeline, numerous partnerships with Big Pharma. But when Biogen reported its positive results for its Alzheimer's drug, that pushed its stock up 60 points in a day, which amounted to over $20 billion in market cap. That's how important this drug was. And again, it's not even a guarantee it's going to get approved. This company has less than a $5 billion market cap and has a similar drug in 2 phase 3 trials with some added benefits. And remember, the FDA is dying to push through anything that's decent. Doesn't have to be great in this space because there's nothing out there. There's no treatments for the market. So if this company's drug gets approved, I mean, we saw what happened with Biogen, and a $20 billion market cap. This is less than a $5 billion market cap. I mean, you can say this thing surged 2x or 3x in a day, and it's not a BS story. It's not a little tiny market cap. I mean, this is a real legit company that has several drugs in the market. They generate revenue. $1 billion valuation. It's a real company. Just it's mostly a foreign company that most of you probably never hear of. So yes, this is a tease, but one that's worth it if you're a subscriber, since I'm going to mention this name of the stock on Friday's Frankly Speaking podcast. That's only available to paid subscribers, Curzio Research. So guys, again, I want to thank you for all the emails. Really, really appreciate all your support. Love doing this podcast for you guys. Keep those emails coming in at frankcurzioresearch.com. I'll see you guys in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.